Ever wondered what bonds are and how they work? Well, you're not alone. Bonds, in the simplest terms, are a type of investment where you, the investor, lend money to an entity. Now, this entity could be a variety of things: a big corporation, a local municipality, or even the government itself. What you're doing is essentially providing them a loan, so in essence, when you buy a bond, you're playing the role of a lender. Now that you know what bonds are, you might be asking, how do they work? Let's delve into that. At its core, a bond works by paying interest to you, the investor, for the duration of the loan. This interest is often referred to as the coupon. Think of the coupon as your reward or return on investment for loaning your money. But how is this coupon determined? Well, it's typically expressed as a percentage of the bond's face value or principal, which is the amount you initially loan when you purchase the bond. Let's consider a simple example. Say you buy a bond with a face value of $1,000 and a coupon rate of 5%. This means that every year, for the life of that bond, you'll receive 5% of that $1,000, which equates to $50 as your interest. However, the bond's journey doesn't end with these annual interest payments. When the bond reaches its maturity date, which is the agreed-upon date when the loan period ends, something else happens. The face value of the bond, that $1,000 you initially invested, is returned to you. So, in essence, by investing in a bond, you're lending your money in return for regular interest payments, plus the promise of getting your original investment back at the end. So if you buy a bond with a face value of $1,000 and a 5% coupon rate, you'll receive $50 annually until the bond matures. At maturity, you get your $1,000 back. Like any investment, bonds come with their own set of risks and benefits. Let's start with the benefits. The first one is regular income. When you buy a bond, you're essentially lending money to an entity. In return, they pay you interest at regular intervals, providing a steady stream of income. The second benefit is capital preservation. Bonds have a maturity date when the principal amount is returned to you. This makes them a less volatile investment compared to stocks. Now, on to the risks. The first one is interest rate risk. If interest rates rise, the price of existing bonds falls. The second risk is credit risk. This is the risk that the bond issuer will not be able to make interest payments or repay the principal. Lastly, there's inflation risk. If inflation rises, the purchasing power of the fixed interest payments from bonds decreases. Despite these risks, bonds are generally seen as less risky than stocks and can be a good way to diversify your investment portfolio. So in a nutshell, that's what bonds are all about. Let's take a quick stroll down memory lane to recap. Bonds, in essence, are a type of loan. But instead of borrowing from a bank, companies or governments borrow from you, the bondholder. In return for this loan, they agree to pay you interest. This is your reward for lending your money. Now, just like any other investment, bonds come with their own set of risks and benefits. They can offer a steady stream of income, which can be particularly appealing for some investors. But they also carry the risk of default, meaning the issuer might not be able to pay back the loan. Despite these risks, bonds can be a valuable tool for diversifying your investment portfolio. They can provide a balance to the more volatile nature of stocks. Remember, the key to successful investing is understanding what you're investing in. And now you know a bit more about bonds.